The Intelligent Investor by Benjamin Graham. Introduction. Today, we are about to explore one of the most respected and influential books in the world of investing, The Intelligent Investor by Benjamin Graham. This book isn't just for Wall Street professionals. It's for anyone who wants to understand how to build long-term wealth while minimizing risk. Known as the father of value investing, Graham's timeless advice has helped millions make smarter financial decisions. Whether you're a beginner or a seasoned investor, this book lays out the foundations for becoming a disciplined, thoughtful, and intelligent investor. About the author, Benjamin Graham was an economist, professor, and investor. He taught at Columbia Business School, where one of his most famous students was Warren Buffett. Graham's investment philosophy centers on the principles of value investing, buying undervalued stocks and holding them long-term for sustainable growth. His teachings stress the importance of understanding a company's intrinsic value, staying emotionally detached from market swings, and always investing with a margin of safety. The core of the book. At its heart, The Intelligent Investor teaches that successful investing is not about getting rich quick or timing the market. It's about being disciplined, informed, and rational. Graham introduces the concept of Mr. Market, a metaphor for the emotional, often irrational fluctuations in the stock market. He advises investors to see these fluctuations as opportunities rather than threats, and to stick to well-researched decisions regardless of market noise. The book also differentiates between two types of investors: the defensive, passive investor, and the enterprising, active investor, offering tailored strategies for both. Summary of the book. The Intelligent Investor is a detailed manual for long-term investing based on thorough analysis and a calm, rational approach. Graham explains that investing is not speculating. Instead of guessing stock prices, an intelligent investor evaluates a company's real worth, its intrinsic value, by looking at its earnings, assets, and growth potential. Graham warns against emotional investing, where panic and greed often lead to poor decisions. He introduces the idea of the margin of safety, which means only investing when a stock's price is significantly below its intrinsic value. This cushion helps protect investors from significant loss. The book also explores the difference between active and passive investing. Defensive investors are advised to keep their investments simple, such as through low-cost index funds or blue-chip stocks. Enterprising investors, on the other hand, may research undervalued stocks, bonds, or special situations, but must be willing to put in more time and effort. Mr. Market, Graham's fictional character, is a tool to teach investors about market behavior. Mr. Market offers you prices every day, sometimes too high, sometimes too low. The intelligent investor chooses when to act and when to ignore him. The book includes deep insights into bond investing, inflation, diversification, market timing, and common investor errors. Graham reminds readers that even the best strategies won't eliminate risk entirely, but with proper discipline, losses can be minimized and gains maximized. Key takeaways. 1. Invest with a margin of safety. This means only buying stocks when they are significantly undervalued compared to their intrinsic value. For example, if a company's fair value is $100 per share, but it's trading at $60, the $40 difference is your margin of safety. It protects against unforeseen losses. Another example, during market downturns, value stocks often become cheaper, offering a great margin of safety for patient investors. 2. Understand the difference between investing and speculating. Investing involves analyzing companies and expecting returns based on fundamentals. Speculating is gambling on price movements without analysis. For instance, buying shares in a well-established, profitable company with stable earnings is investing. Buying a stock because it doubled last week with no earnings history is speculating. 3. Focus on intrinsic value, not market trends. Instead of following hype or trends, intelligent investors assess a company's true worth. For example, while tech stocks may surge in popularity, a value investor will only invest if the company's fundamentals justify the price. A good case is Coca-Cola, which Warren Buffett held for years because of strong fundamentals, not market excitement. Step 4. Be a defensive or enterprising investor based on your personality. A defensive investor seeks simplicity and low risk, often investing in index funds, government bonds, or blue-chip stocks. For example, someone with a busy career might stick to a 60-40 stock-bond portfolio. An enterprising investor seeks undervalued assets, such as small-cap stocks or distressed bonds, with higher involvement and risk. For example, researching lesser-known companies with strong balance sheets that the market ignores. Dara 5. Don't let emotions guide investment decisions. Fear and greed lead to panic selling or overbuying. Graham advises staying rational. For example, during a market crash, many panic and sell at a loss, while intelligent investors buy quality stocks at a discount. Likewise, when markets rise too fast, avoid jumping in without fundamentals to back up prices. 6. Mr. Market is there to serve you, not guide you. Mr. Market is emotional and unpredictable. Use his mood swings to your advantage. If Mr. Market offers a great business at a bargain, buy it. If he's euphoric and overpricing everything, stay calm and do nothing. 7. Diversification protects you from risk. Don't put all your eggs in one basket. Spread investments across different sectors and asset types. For example, owning tech, healthcare, energy, and financial stocks reduces the impact if one sector crashes. Sus 8. Avoid timing the market. Trying to predict highs and lows rarely works. Instead, focus on consistent, long-term investing. For instance, investing a fixed amount monthly in index funds helps avoid emotional market entry and exit. 9. Focus on long-term results. Real wealth is built over years, not weeks. An example is buying dividend-paying stocks and reinvesting the dividends for decades, allowing compound interest to grow wealth steadily. Dar 10. Always do your own research. Don't blindly follow advice or trends. Analyze financial reports, company history, and market conditions yourself. For example, before buying any stock, study its income statement, balance sheet, and recent performance trends. How this book is useful. The Intelligent Investor is useful because it builds the right mindset for financial success. It helps readers develop the discipline to invest thoughtfully, ignore short-term market noise, and build a strategy